Hello everyone. In this video, we are going to discuss amendments of CA final audit for May 22 exams. See, every year in the month of November, December, Institute comes up with new module. So we have compared the new module and the old module. We have identified what are the differences, and those differences, so you can call them amendments, you can call them module addition or whatever. So they are covered here. This lecture will be of around 1 hour. Within an hour, we are going to cover all the changes. So you can say that changes are not much. In chapter of bank audit, there are small changes. So we are planning to make a separate video on that. We are planning to make a amendment come revision video. We plan to make a complete chart on bank audit, and we'll be covering the whole chapter with the help of that chart. It is going to take time. So it will come maybe in next month. By the end of the next month, it will be there. So don't worry about it. Just relax. Study whatever you have studied till now. Cover everything, all the videos which are available with you, notes available with you, and after that you can take these lectures as amendment and addition. See, in audit is not like DT or IDT. That whole interpretation is going to change. Everything is going to change. No, changes are majorly of addition nature, and there's something. There'll be change in number of days or something like that. Okay, let's start. We start with chapter number 7. In first 6 chapters, now these chapters are as per the ICAS study material. Okay, in first 6 chapters there are not many changes. Let's see the changes. Chapter number 7, audit committee and corporate governance. So topic is applicability of LODR. There were small changes in applicability of LODR. We have covered the whole thing. Instead of just focusing on what is the change, we have covered the whole thing. So LODR is applicable to all the companies whose designated securities are listed on recognized stock exchange. Now, what do you mean by recognized stock exchange? Recognized stock exchange means stock exchange which is approved by central government under Securities Contract Regulation Act. There are around 9 recognized stock exchange in India as on today. They have given list of securities. So if these securities are listed, LODR will get applicable to you. Fine. Now let's see the list. The first is very popular. They say that if specified securities are listed, LODR will get applicable. What do you mean by specified securities? It includes 2 things. If equity shares are listed, LODR equity shares, and second, convertible securities. That means convertible preference shares and convertible debentures. If these 2 things are listed, LODR will get applicable. Now, they have further clarified that in some stock exchanges, there are multiple trading platforms. There is a main trading platform. Then there are small and medium exchange trading platform. Then institutional trading platform. So they have specified if these securities are listed on any platform, it can be a main board which is accessible across the nation to everyone, or it is a small and medium enterprise exchange, SME exchange, or innovators growth platform, that is institutional trading platform. If equity shares or convertible instruments are listed on any platform of recognized stock exchange, LODR will get applicable because these securities are generally popular in all the 3 platforms. Apart from that, there are more securities. Now these securities are listed on the main stock exchange only, so they have not put any clarification. NISU can be considered as a shortcut and stand for non-convertible securities. If non-convertible securities are listed, LODR will get applicable. IDR, Indian Depository Receipts. If foreign companies, they come to India, Indian capital market, and get their shares listed, it is called IDR. So LODR will get applicable to them also. Next is security receipts. Now, if some loans have become bad, they are transferred to asset reconstruction company. And this asset reconstruction company sells ownership of these assets. They are going to sell ownership of these assets by issuing security receipts. And if now these security receipts are listed on stock exchange, LODR will get applicable to that asset reconstruction company. Simple. So if asset reconstruction company is issuing security receipts and giving ownership of the bad loan to people, it is listed, LODR will get applicable to it. On the same lines, securitized debt instruments, ownership of the loan can be given to people by issuing again securities, securitized debt instruments. If these securities are listed, again LODR will get applicable to such company. Units of mutual fund, U is for units of mutual fund. If units of mutual fund is again listed, LODR will get applicable. Okay. Now let me tell you guys. So if these securities are listed, simply there's a list. So we have divided in two parts. That is popular one and then the other securities. In LODR, there is a separate chapter. LODR is divided into chapters. So there's one chapter if your specified securities are listed, that is equity or convertible debentures bonds. If your IDR are listed, there's a separate chapter. If your mutual funds are listed, there's a separate chapter. So there are separate chapters for each category of listing. Okay. So the change is amendment is earlier there was some complication regarding regarding redeemable preference shares, irredeemable preference shares, perpetual preference shares, non-perpetual preference shares. There were confusions regarding this. So they have removed all those confusions and they have basically simplified this particular list. That is the amendment. Next, in LODR, you must be aware, some of the requirements are based on market capitalization. If if you are in top 500 companies or top 1000 or top 2000 as per market capitalization as on last date of the previous financial year, that is 31st March, then some requirement gets applicable to you. That's absolutely fine. You will get applicable. And now what is the interesting thing? Even if you fall out of the criteria, if you are not in top 500, 1000, 2000, then also requirements will remain applicable to you. So it's like once it is applicable, it's always applicable, even if you are not covered in the threshold. Now that's very interesting. Now, see, SEBI is getting more concerned about debt instruments also. They have come up with a new terminology, high value debt. What is this terminology all about? See, if a company has listed its debentures, non-convertible debentures, and as on 31st of March last year, it is 500 crore or more. That means large part of the debt is listed. Then such companies are called HVD, high value debt entities. High value debt listed entities, a new terminology, HVD. See, chapter number 4 of LODR regulation, they have come up with a new category of entities. All the content which is in green, these are our comments just for making understanding better. So we have chapter 4 of LODR, which covers regulation 15 to 48. Out of that, 15 to 27 is specifically for making corporate governance better. Corporate governance matters. Earlier, chapter 4 was applicable. It was formed. It was applicable only to equity shares and convertible securities, that is specified instrument. Now the change is regulation 15 to regulation 27 of LODR is now applicable to HVD listed entities also. That's a big change. So all the corporate governance requirement which we study in audit in corporate governance chapter, all of them were applicable for entities where equity shares are listed or non-convertible debenture. Now they are applicable even to HVD listed entities. That's a big change. That's a big change, guys. So you keep in mind now, HVD listed entities need to follow all the corporate governance requirement of LODR. And what the interesting thing is, if an entity is HVD, correct, because its debentures are 500 crore or more in previous year, even if debentures go below the limit, still it will remain HVD. Similar to what we have studied in market capitalization. Once you are HVD, you will be always HVD. Again, that's interesting. Role of audit committee, guys, we have made beautiful charts. We have made beautiful charts on corporate governance. We have covered them in our FADU chart book. And we have issued smart book in English, in the sense that there's a smart book and there is an audio revision for each and everything which is called in the chart book. You should make full use of it. About an hour, in 60 minutes, you'll be able to revise the complete corporate governance. So we have made a chart regarding role of audit committee. So they have increased the role. Earlier there were 21 points. Now they've increased it. 22nd point. It is responsibility of the audit committee to study, examine and evaluate all the amalgamations, merger and demerger schemes. Specifically, what is the cost involved? What are the costs involved? What are the benefit involved? Impact on the company, shareholders and everyone. and they are supposed to put a comment on it. So the role of audit committee has been increased. Next is obligations. See, corporate governance. Corporate governance means FAT, fairness, accountability, and transparency. Taking decision, keeping everyone in mind, fairness. People should work with responsibility, and there should be transparency of information. And directors and senior management play important role. So LODR specifies what are the obligations of the directors, key management person, directors, and senior management. They have specified obligation. So there are changes in this obligation. Now the first change is they have deleted something. What is this deletion all about? Very simple, guys. See, we all know about non-executive directors. Non-executive directors are not employee of the company. They come for the meetings, they attend the meetings, and then they go back. So they are considered comparatively neutral. Non-executive directors can have shares of the company, no problem with that. They can have any percentage of shares, but then they should disclose it to the people that they have so much percentage of shares. So there was an obligation on non-executive directors that you inform the company what percentage of shares you have on your name directly or indirectly as a beneficiary. And then company will inform shareholders in AGM, this is the shareholding of non-executive director. Now they have removed a requirement that non-executive director is not supposed to inform company what is his shareholding. But communication from company to shareholder is still applicable. So they said that, okay, this is some procedural part, or this is something company can find out easily from their records, from their shareholder register or something like that, or they already have access to it, or they will simply ask. So they have removed this particular obligation that non-executive director is supposed to communicate to the company. There is no real change or real impact or significant impact because of this change. Next. We all know that there's a requirement. A person can be member in maximum 10 committees, and he can be chairman in maximum 5 committees. There's a requirement. There's a maximum limit. And when we talk about this, we should consider only public companies, and that too only 2 committees: audit committee and stakeholder committee. Only 2. We are not supposed to count private companies, foreign companies, Section 8 companies. And now, as a clarification, they say that we are not supposed to count high value debt listed entities also. HVD entities should not be counted. It's just a clarification. Again, it's not going to have much impact. Now, D&O insurance requirement. Now, module has first time included this point, and they have covered only one paragraph. But I thought both the paragraphs are required to understand it. It's a very simple requirement. LODR says that independent directors play a very important role in corporate governance. So we have non-executive directors, and then we have independent directors. We can say that independent directors are much more detached from the company as compared to non-executive directors. Both are neutral, but then the level of unbiasedness in independent director is much higher as compared to executive director, non-executive director. So LODR says that you should take care of your independent directors. So it says that top 500 listed entities should take director and office insurance for all the independent directors as per the policy which is approved by board of directors. Take care of your independent directors. Take an insurance policy for them. Now they say that the same requirement is applicable for high value debt listed entities also. In case of high value debt listed entities, directors and officer insurance is again required. And this policy will be as approved by board of directors. Then this thing was already there, correct? We are just emphasizing on it so that it should not get missed. At least once in a year, independent directors are supposed to meet. At least once in a year, they are supposed to meet, supposed to have a meeting where only independent directors are there. Other members of the management and board are not there. So they can simply openly talk about any other issues or matters regarding other management people. So there should be one such meeting every year. Fine. Then next is subsidiary. LODR wants that company should have a good control over its subsidiaries. And they have mentioned things which should, they have specified things which will ensure good control over subsidiaries. Now, one such requirement is if there is a material subsidiary which contribute 20% or more with respect to revenue or net assets, material subsidiary. Correct. In case of material subsidiary which is giving a good contribution to the group, if you want to bring shareholding lower than 50%, special resolution is required. Holding company will have to pass special resolution if you want to bring shareholding below 50%. They have tweaked, they have rectified the wordings. They have said if you want to bring holding to 50% or less, so this is the change. If you want to bring shareholding to 50% or less, special resolution will be required. They have changed this wording because, and it's logical. You lose control of the subsidiary when you come to 50%. If you want to control an entity, you need more than 50%. More than 50%. If it is coming below 50%, guys, it is coming below 50%, then so earlier only that time special resolution was required. Now if you come to 50% or below that, in both the circumstances special resolution will be required. Next is secretarial audit and sectoral compliance report. Now requirement of secretarial audit was already there. The new requirement is secretarial compliance report. Let me compare both of them. Every listed and material unlisted subsidiary need to get secretarial audit done, and they need to submit secretarial compliance report also. It's applicable to, this condition is applicable to listed and material unlisted subsidiaries. In secretarial audit, practicing company secretaries goes and checks compliance of all the laws which are applicable to company. All the laws, whether there's compliance with all the different types of laws which are applicable to company. So they issue secretarial audit report on that. When it comes to secretarial compliance report, it talks about compliance of only SEBI Act and regulations. Okay, secretarial audit report, there's a coverage, a lot of laws are involved. We check compliance of all the laws. Here it is only SEBI Act and its rules and regulations. When it comes to secretarial audit report, it is submitted along with the annual report. You get a lot of time to complete it and to give the report. But when it comes to secretarial compliance report, you get only 60 days from the end of the financial year. There's a difference. When it comes to secretarial audit report, this report is sent to shareholders. It is included in annual report. When it comes to secretarial compliance report, it is sent to stock exchange. So there's difference in number of laws which are covered. There's difference in the time limit also. And at the same time, to whom it is submitted, there is difference in that also. To whom it is submitted. Okay, that's very interesting, guys. That's very interesting. And this is because SEBI Act and its regulations are much more important, and it should be, people should be aware about it. They should come to know about the compliance as early as possible. So they have included a new requirement of secretarial compliance report, and both the things will be done by practicing company secretary. Now next is risk management committee. Let's talk about risk management committee. First of all, applicability. Risk management committee is applicable to top 1000 listed entities as per market capitalization. Who is going to make it? Board of directors are going to make it. Okay. How many members will be there? There will be minimum 3 members. There will be 3 members in this committee. Okay. So you are going to have board of directors are going to constitute it, minimum 3 members. Board of directors can also become the member, and senior executives can also become the member. So that's a unique thing, that senior executives can also become the member. But majority of the members should be board of directors, and there should be at least 1 independent director. And if the company has issued SR equity share, that is superior right equity share, those who have higher number of voting rights or dividend rights, then in this particular case, okay, then in this particular case, requirement will be 2/3. At least 2/3 of the board, 2/3 of the committee should be independent directors. Further, chairperson of the committee should always be a board of director. It should be always be a board of director. So now we know about the applicability, we know about the constitution. Now what about the meetings? What about the meetings? When we talk about the meetings, they should meet at least twice in a year, at least 2 times in a year, and the gap between the two meetings should not be more than 180 days. Quorum should be 2 members or one third of the total number of members, whichever is higher, and at least one member should be board of director. Generally, they specify minimum requirement for independent, but here they say at least one should be board of director. Fine. Roles and responsibilities. Risk management committee. Board of directors should define what the roles and responsibilities generally includes monitoring what are the changes required in the risk, reviewing risk management policy plan and what changes are required, and specifically covering cyber security. That's the new area of the threat, new area of the risk, so it should be carefully covered. Apart from that, we have schedule 2 in LODR. We have schedule 2. In schedule 2 we have part D, and this part D specifies roles of the different committees. So whatever matters are there in schedule 2 part D, those things should be definitely covered in roles and responsibilities. So board of directors will decide it, correct? And as an overview, it is going to cover reviewing and monitoring the risk management policies and plans, and it should definitely cover the matters which are given in schedule 2 part D. What are the powers? They can call for information from employees of the company. That's the very simple power. Then on the higher side, they can get consultation from outside also, outside professionals also. And then bigger than that, they can secure attendance of outsiders with relevant expertise. They can ask outsiders to attend the meeting also. They can talk to employees, they can talk to outsiders, they can invite them to their meetings and do the discussion. These are the powers. As an auditor, to check compliance of all of them, whether company has formed such committees with the proper constitution, and are they meeting regularly, are they discussing proper plan. This is a responsibility of the auditor to ensure that committee is formed, ensure that there are adequate number of members, proper composition of members, and the chairperson is a board of director. So it is simply checking compliance of the above matters, nothing else. Related party disclosure. The related party disclosure need to be given. People should be aware what are the transactions which are happening with the related party disclosure. We have made a very good chart regarding the same. So one of the requirement is, as soon as you prepare your financial statement, standalone financial statement, and then consolidated financial statements, within 30 days of preparing consolidated financial statements, as you prepare half yearly financial statements and annual financial statement, within 30 days of preparing these financial statements, okay, disclosure given in notes to account for related party as per accounting standard Ind AS, as given in consolidated financial statement, need to be sent to stock exchange, and it should be published on the website. So as soon as half year ends, you make financial statements and there is note of related parties. As soon as you publish these half yearly financial statement, that note should be submitted to stock exchange within 30 days, and it should be there on the website. Now the same requirement is applicable to HVD also, but then when it comes to HVD, they have specified something. What they have specified, that you have to submit a related party disclosure from standalone financial statements, not from the consolidated financial statements. So they are reducing some requirement. They are reducing requirement, correct? In normal companies where equity shares and convertible debentures are listed, you have to submit both. In fact, consolidated basis means both together, standalone as well as consolidated financial result, both together you have to submit. But in case of HVD, you are supposed to submit only standalone financial results only. So that's the change. Then report on corporate governance. We all know that report on corporate governance need to be submitted. Only number of days have changed, within 21 days from the end of each quarter. Okay, no change in consolidated financial statements. And with respect to bank audit, we have planned to make a separate video on that, so please wait patiently for it. Insurance, there is no change. NBFC, there is no change. Tax audit, the great news is GST audit is removed from the course. That's a good thing which has happened to the student community. Okay, you should be happy for that, you should cherish it. And then there's a small change. Okay, What is the small change? We all know that if assessee is having 95% of receipts through 95% of receipts and 95% of payments through banking channel, then the turnover limit increases from 1 to 5 crore. That was the case. Now it has changed from 1 to 10 crore. So turnover limit will increase drastically. It will go to 10 crores if 95% of the receipt and payments are through banking channel. Earlier this was 5 crore. Apart from that, this guys, there are more changes, but we have already covered these changes along with the November 21 amendments. We have already covered them with November 21 exams amendment. Now link which is given here, it can be of Hindi version. It is of Hindi version. So I'll say that simply search CA Ravi Tauri amendments November 2021 English, and you will get, we have covered, it's a hardly 1 hour lecture, and it covers the changes in the tax audit. Clause 44 is further deferred. That's a good thing. Fine. Good for the professionals, good for everyone. It's deferred. Applicability is deferred till 31st of March 2022. So if we are talking about financial year 21-22, when we'll make Form 3CD for this particular financial year, no need to report on clause 44. Great. Then no change in chapter 13, 14, 15, 16. There's no change at all. And then we have peer review. Statement on peer review has changed. It has revised in July 21. It's not like that the complete chapter has changed. No, guys, the complete chapter has not changed. It has not changed. But then obviously there are some changes. So let's see those changes. In the peer review process, what I've done is I have instead of highlighting what are the changes or explaining what are the changes, I'm going to cover the whole peer review process. That's going to make things pretty easy and simple. Let's see. First of all, we need to understand peer review process is divided into parts. First is selection phase. So there is a selection phase. After selection, there is a planning phase. After planning, there is an execution phase. And then next, there is a reporting phase. Okay. There are 4 phases. Let's see. In selection phase, peer review board plays a very important role. What it does? Peer review board is going to select practicing unit, that is CA firm, who will be for CA firm. They will select the CA firm for whom peer review will be conducted. So peer review board, PRB, is going to do selection of the CA firm, and they are going to intimate you. Congratulations, you are selected for peer review. As soon as they're intimated, within 7 days, CA firm is supposed to give a declaration regarding what kind of entities they audit, so that it can be decided whether they fall in level 1 or level 2. And apart from that, now there is a change, a questionnaire, detailed questionnaire giving details of different assignments they have done in past 3 years, partner details, employee details, fee collection, what are their policies, how they conduct audit, what is their quality control system, everything. You need to give a questionnaire within 7 days. So within 7 days, they are going to send 2 things to peer review board, a declaration and also questionnaire. So there is a change. Earlier, they were given a lot of time for questionnaire. Now they want it within 7 days. So everywhere they have reduced number of days. That's the change. Now peer review board, after getting the information, they will study it, analyze it. They will make panel of 3 reviewers and send it to the practicing unit. Oh dear, practicing unit. You can select reviewer from whom you want to get your firm reviewed. And within 7 days, they need to reply. So you CA firm gets 7 days to send first reply, declaration and questionnaire. You again get 7 days to select the reviewer from whom you want to get your firm reviewed. After that, PRV will inform the reviewer, oh, listen, are you ready to do the review? Because the CA firm has agreed. So they will take the consent from the reviewer within 7 days. So the whole thing of selection, which CA firm will get reviewed and who will do the review, this may take maximum 21 days. It may take 21 days. Okay, fine. Now, the selection phase is over. The next phase is the planning phase. You need a lot of information to do planning. First information will come from practicing unit, that is CA firm. Within 2 days, as soon as CA firm is intimated that reviewer has agreed to do peer review of your firm, within 2 days, they have to send copy of the questionnaire which they send to the peer review board, same copy they have to send to the reviewer. So question is going to have list of assurance services, nature of services, fees charged, policies, procedures, how they maintain independence, how they maintain skills, how they ensure supervision, how they ensure review, etc. Everything. Then they are also supposed to send details of all the proceedings, that is pending cases against the CA firm, against the partners, against the assistants, which are pending for preceding 3 years from the period of review. So period of review is 3 years, and then 3 years before that, so almost 6 years. So you have to give details of almost 6 years what are the pending cases. This information is going from CA firm to the reviewer. Apart from this, reviewer can ask for more information, whatever they want. Now the information will also flow from Union Directorate. Peer review board will take information from Union Directorate, give details. How many assignments they have signed, which partners have signed which assignments, give that list. They will take it from the Union Directorate and give it to the reviewer. So reviewer will get information from the Union Directorate also. Now, after getting this information, the most important plan of the planning will be how many assignments they are going to review. So after collecting all the information, reading and analyzing it, they will make the initial sample within 7 days. Within 7 days of receiving the information from the practicing unit, they will have to select list of the assignment they plan to review, send this list, one copy to the CA firm and one copy to peer review board. One copy to CA firm and one copy to peer review board. Both of them will be informed. These are the number of assignment we are going to review. Then after intimation, you have to give, reviewer has to give at least 5 days, to make all the arrangements, and then go for the on-site review or for initial meeting, and ensure that peer review report is submitted within 60 days of intimation sent to CA firm. Within 60 days it should get over. Again, there is a change. Wherever you will find that things are written in red, those indicate changes. Earlier 90 days were required. The planning phase gets over. Next is execution phase. For execution, reviewer will go to the CA firm's office. That's called on-site review. They can stay there. They can do on-site review for maximum 7 working days. Again, there is a change. Earlier there was 7 to 14. So everywhere they have reduced number of days. Now when we talk about what they are going to review, the first thing they are going to do is compliance review of general controls. See, general controls are extremely important. So what is given by this general control? So how they ensure good proper staff recruitment, then how they ensure system they have after recruitment, how they ensure their staffs are trained, they are trained for skills and standards, how they ensure they have independence, they maintain independence, how they ensure they get proper consultation when they are stuck in their work. So first staff will come, then they'll get trained, they'll go on audit, they should be independent. When they are stuck, they should get the consultation. It's in a sequence. It is purposefully arranged in a sequence for ease of learning and ease of memorization. And then finally, how good is the office administration for non-audit work, like attendance, salaries, billing, recovery, etc. It's a non-audit work. Then, so first they will take general controls. After that, they will finalize the sample size. After doing some initial meetings, they will finalize the sample size, the factors they will keep in mind. So they may increase number of assignments, they may decrease number of assignments, they may change some assignments, replace them. It should be done. How big is the firm? What is the size of the firm? What is the size of the firm? How many people are there? So size and nature of assignment. So what are the number of clients, size, and what are the nature of services they give to their clients? Size, number of partners, number of employees, then number of location and branches. So how big is the firm? Size and nature, partners and locations. How they work. What is the level of the quality control system? What is the level of audit quality control system which is existing in the firm? Are they having good system for doing the audit? What is the methodology they have? Whether there is a manual auditing, there is a system-based audit, there are computer system-based audit, and fees charge. These are the things which will be seen while deciding the final sample size. Now, review of the records. Review of records. See, there are 2 approaches. Just like in audit, we have test of control and substantive checking. On the same lines, we have 2 approaches here. Okay, we can go for extensive test of control and less substantive procedure, and vice versa. On the same lines here, we have compliance approach or substantive approach. If you think that if firm is having very good audit quality control system, well-defined policies, well-defined checklist, well-trained people, you can go for compliance approach. You spend more time on testing their systems. Are they having good system for test of controls, then substantive test, then checking presentation of financial statement for conclusion and reporting, and for having records, maintenance and administration of the assurance service records. If they're good at it, we'll spend less time, we'll spend more time checking how good is the system and how actual audit was done. On the other hand, if you think that audit quality control system is not that great, don't spend time on testing audit quality control system. Directly focus on the working paper of each and every assignment and ensure that it is done as per technical, professional, ethical standard. So in one approach, you focus more on controls, less on the actual assignment files. In other approach is opposite. Now reporting. Report after the peer review is done, we have to make report, and we make report under these headings. How good is the recruitment, then maintenance of skills and standards, independence, consultation, office administration. It will be made in this. If there are deficiency in the quality control systems or how they are doing the audit, how they conducted the audit, preliminary report will be prepared, and it will explain what the deficiency in the audit quality control system and how they are doing audit. Preliminary report will be made and sent to CA firm. CA firm will have to reply and explain whether the points allegations are correct or not. They will get 5 days. Within 5 days, again there is change in number of days. Earlier 15 days were given. After receiving reply from the CA firm practicing unit, if reviewer is satisfied from the CA firm, he will make final report that I am satisfied with the quality control system, how audit is done in the CA firm. Absolutely fine. I have no problem at all. He will attach preliminary review report and also the reply. If it is not satisfied, again he will make that he is not satisfied, so and so are the issues. He will attach preliminary review report, and along with that he will also attach reply also. If they are dissatisfied, they will get 1 year's time to improve themselves. After 1 year, follow-on review will be announced. If they want to get the review conducted early, because then only they will get the peer review certificate. They can ask for it within 6 months. In either whatever it is, within 60 days it should get over. Now applicability. When we talk about applicability of the peer review, peer firms are divided into 2 levels, level 1 and level 2. So who will come in level 1? There's a shortcut. I made BCP plan for level 1. I for Ind AS. If client is following Ind AS and you are doing statutory audit, you are in level 1. BCP, B stand for if you are doing statutory central audit of any bank or insurance, you are level 1. Correct? Simple. So if there is a separate branch auditor and you are doing the central thing, you are level 1. If there is no central auditor, there is no branch auditor, there is only central auditor and who is doing everything, again you are into level 1. PCP, if there is a central cooperative society or a public sector undertaking, so these are government entities, central cooperative society, public sector undertaking, and turnover is exceeding 250 crores or net worth is exceeding 5 crores. If you're doing audit for them, you are level 1. CP, P stand for if you're doing audit of public interest entities. Now regulatory authorities can declare anyone as a public interest entity where a lot of people are involved. If you're doing audit for such entities, you are level 1. Then L is for listed in India or outside India. If you're doing audit of listed entities, you are level 1. Asset management company or mutual fund. If you're doing audit of asset management company or mutual fund, you are level 1. Then net worth. Then simple net worth. If you are doing audit of entity having turnover above 250 crore, 250 crore or above, 250 crore or above, or net worth 100 crore or above. Now compare. Turnover limit is same, but the net worth limit has changed. That was 5 crore is 100 crore. Again, you will be level 1. If you're doing audit for NBFC, where the deposits taken by the NBFC is 100 crore above, 100 crore or above, again you will fall in level 1. You will be level the CA firm. If you're doing audit of 50 crore club, people they have raised money from banks, financial institution, 50 crore, over 50 crores, or over 50 crores, or they got donations or contribution above 50 crore, or they got central government, state government funding above 50 crores. So if they have raised more than 50 crores, either through banks, financial institutions, Okay, let's either through central or state governments, or through banks, financial institutions, or through donations or charity. Correct? They will be level 1. If you're doing branch audit, statutory internal tax branch audit of any bank, insurance, or PSU, if you're doing audit for them, it will be level 2. Okay. And if you're doing audit for NBFCs, not coding level 1, again it will be level 2. Again it will be level 2. If you're doing audit, if you are doing audit more than the specified number, if you are generating UDIN more than the given number, that number is not yet given, again you'll be level 2. And see, the funny part is, apart from this, all the firms will come in level 2. You could have simply said that all the firms will come in level 2, but they have specified a few things, then they have said this. So basically, all the CA firms who are into assurance services, either they will fall in level 1 or level 2. If you're not in level 1, you will go to level 2. All need to get their peer review done. Period changes for both. Now, special case review. PRB can get information from regulator, below that maybe secretary of ICI, or below that disciplinary directorate, and after receiving the information they may feel that this firm is doing something grossly wrong, they can announce special case review. Special review. So this is very interesting. A special review can be announced after receiving information from these guys. The last thing, and that is professional ethics. Professional ethics, there's a new topic they have added. Interesting, but they have not gone in detail. There is an overview of this topic, that is no clar. No clar is a very famous thing. Very simple. What do you mean by no clar? Suppose you are giving services to a client as a chartered accountant, or you're doing job in a company, in an entity, and if you come across non-compliance of law, your client is involved in non-compliance, your employer is involved in non-compliance, or TCWG or management or employee of such clients or your employer are involved in non-compliance, such situation is called no clar, non-compliance with laws and regulation. So there's a, see, we are having new code of ethics which has recently got applicable, and in that there is section 260 to 360, which is specifically there for no clar. It is applicable from 1st of April 2022. So in code of ethics there is a dedicated section 260 to 360, so and that is specifically there for no clar. So they are giving an overview of that section. They are not going in detail. They are simply giving overview of that particular section. So that section is going to tell you what to do when you come across such situation. What should be done? So it specifies a lot of things. Correct? Let's see one by one. So no clar, we know what do you mean no clar. When you come, when you are performing your professional duties, and when you come across non-compliance done by so and so people, it is considered no clar. What do you mean by non-compliance? What do you mean by non-compliance? It's very simple. If there is a omission involved, you are not doing something which is required by law, or you are going against it, doing something contrary or something incorrectly as going the law. If you're omitting it, or there is something you're not doing properly, there's a commission, or there is contradiction, complete contradiction. Correct? It's a non-compliance. And it can be done by anyone. The same list continues, either by the client or the employer or TCWG management or employee of such people. So we know what is a no clar situation. We know what do you mean by non-compliance. Again, non-compliance of law by these guys, nothing special. The guidance is for no clar. It is not going to cover instances of personal misconduct. If TCWG or employees, they're getting involved in personal misconduct, they are physically abusing any employee, now that's a personal misconduct. That situation will not be covered. Correct? They are having some affair with someone of the employee and their allegations of exploitation, that is a personal misconduct, that will not be covered here. That will not be covered here. Okay? Only things in which any business or professional activity involving Non-compliance will be covered here. Personal misconduct won't be covered. Give example of the laws, not very important. So see, if you are, they may ask you the definition. What do you mean by no clear situation? What do you mean by non-compliances? Whether personal misconduct is covered or not, it may come in MCQ. Give examples of the laws. It covers almost all the laws. They give examples of the laws which are related to the financial crimes. So we have sequenced it properly. Money laundering, terror financing, then below that bribery and corruption, below that insider trading, below that frauds, uh, accounting frauds, below that tax evasion. So these are financial crimes related laws. Then financial matter related laws. Laws related to financial products and services, data protection. Those laws will also be other laws. Environmental protection laws are applicable to some manufacturing companies. Public health and safety may be applicable. So these are the different laws which may get applicable to the clients, to the employer. And as a professional, you should be aware about these laws and what to do if there is a non-compliance. See what it says, that why this nuclear why there is so much of emphasis on this. Whenever you come across this situation, don't turn, don't ignore it. If you come across nuclear situation, non-compliance of law by client or by employer or people involved, don't ignore it, don't avoid it. Don't simply say that, oh, confidentiality, I will not look into it. That's not a proper response. There should be proper response in this particular situation. And we will tell you, NOCLAR will give you principles how to react in this situation, how to respond in this situation, how to act in this situation. We will tell you whom to inform, where to report, how to report. We will explain you. Fine. Now, some important facts about NOCLAR. So, when we are doing our professional work, either towards client or towards our employer, during that course of professional activity, when you come across non-compliance, then you have to follow NOCLAR. It doesn't say that you have to do a separate assignment of ensuring compliance with law, rules or regulation, or separate investigation. No. When you are doing your regular professional work for your client or for your employer, and during that time when you come across non-compliance, NOCLAR will guide you. NOCLAR is not going to guide you in assignment, in compliance assignment to check compliance, or it is not going to help you in investigation. So please don't misinterpret it, don't misuse it, don't misapply it. It is not for separate investigation or separate compliance assignment. No. Chartered accountant is not supposed to have expertise of the law also. To follow NOCLAR, to apply NOCLAR, he's not supposed to have extraordinary expertise of the law. To have a reasonable understanding of the laws, to understand the effect on the business and the financial statement, that will be sufficient. Certain matters, inconsequential, immaterial matters are not covered in NOCLAR. No need to apply NOCLAR for that. And personal misconduct, no need to apply NOCLAR again. Now, some things are very unique. There's a complete change in approach in NOCLAR. Generally, the approach which was taught to us, which we have discussed earlier, the approach was maintain confidentiality about everything. Go and inform authority only if law says. And in NOCLAR, they are having a different approach. Specifically, if there's a big non-compliance, they are saying that go and inform authorities unless someone restricts, if the law restricts you. So there is a change in approach. NOCLAR wants to say that be more vocal about the non-compliance. Just don't hide behind confidentiality. Be more vocal towards non-compliance. Go and tell people unless you are restricted. There's a change in the approach. And I think it's going to have big impact in the upcoming time when chartered accountants will directly go to the authorities and inform about non-compliances. Now, how there's a difference between that's a very important question, I feel. This can be targeted in exam. How NOCLAR and SA 250 they are different from each other. SA 250 is applicable to the audit of historical information. It is applicable to regular audit assignments. What auditor is supposed to do with respect to non-compliance when he is performing audit of financial statements? It covers only one assignment. On the other hand, NOCLAR is covering a lot of things. When you're doing any kind of professional assignment for your client, and when you are doing a job for your employer, it is covering all the situations. It is covering large number of different types of assignments. What to do in that situation is covering that. Laws covered. SA 250 focuses on the laws which are having a big impact on operations of the company and on the laws which are having direct impact on financial statements. So it is more focused on financial statements. Laws having direct impact on operations of the company which will ultimately affect financial statement, and laws which are having direct impact on financial statement like tax laws, like labor laws, like Schedule 3 and so on. Okay, it's more focused on financial statement, but NOCLAR is not like this. It talks about all the laws which can have substantial effect on the entity, whether in financial terms or non-financial terms. So again, coverage of the law has also increased. SA 250 simply says to auditor, focus on financial statement. Whether financial statement is showing proper true and fair view, financial statement is showing true and fair view, whether proper accounting is done. NOCLAR says that consider effect on all the stakeholders, whether it is government, whether it is investor, whether it is creditor, whether it is employee, everyone. Disclosure to authorities. Now, this is where there's a drastic change. It says that if you come across a very big non-compliance, directly go to the authorities and tell them about it, unless there is a law which stops you from doing it. So this thing is a change. NOCLAR says if there is an imminent breach, big breach, go to the authorities. And earlier it was unless otherwise required by law, don't go anywhere. In big non-compliances, there is a difference. There's a big change as per NOCLAR. Which authority you should go to, that depends on the circumstances, in which industry you are there, what kind of non-compliance is there. Some people may go to SEBI, some people may go to RBI, some people may go to IRDA, some people may go to ministry, depending on the situation. So section 260 to 360 is there. It is applicable from 1st April 2022. But the most important thing is NOCLAR is applicable only when you're doing audit of listed entities or you're doing job at listed entities. If you're doing audit of listed entities or if you're doing job at listed entities and you come across this, go and inform. You have to take steps. What exactly you have to do when it comes to NOCLAR, that is not in the course. What exactly am I supposed to do? Okay, just take an overview. This chart is directly from the module. It says that if you're doing job, if you're into job, if you're in employment, okay, they have divided the responsibilities for senior professionals, senior professional accountants, and responsibility for people other than senior professional accountant. So we have responsibility for senior professional accountant and other than senior professional accountant. And then they have defined responsibility for professional accountant who is doing audit. So they have, in NOCLAR, they have specified responsibilities for different people. If you're doing a job as a senior accountant, there is separate set of responsibilities. If you're other than senior, there is a separate set of responsibilities. If you're doing audit, there is separate. In all these set of responsibilities, there is a common thing, common steps. They are giving you overview. So whenever you come across NOCLAR, first obtain understanding. That's common sense. This is a common sense. First obtain understanding what kind of non-compliance, what law is involved, rules, regulation are involved. Understand the in-depth thing, what was required, what wrong they did, what is the financial, non-financial impact, obtain the understanding. Then addressing the matter. This is the most important thing. In some cases, they have specified go to seniors. In some cases, they have specified go to seniors or go to authorities. So they have specified different responses. How to address this matter, how to tackle this matter. There is separate responsibility in each category. If you are confused, you can take advice from outsider. Don't worry about confidentiality. Then after addressing the matter, are you supposed to take more steps? Further action? Specifically think about it. Are you supposed to go to appropriate authority? Are you supposed to go to higher authority? Are you supposed to go to outside entity? So they give you how to address the matter. After they will tell you go to seniors, go to management, go to TCWG, go to discussions, ask for rectifications. They will explain everything. Then even after doing that, they say that think about it. What else you're supposed to do? Are you supposed to go to appropriate authority? Further, they say that if it is an imminent breach, very big breach, higher authority of the organizations are involved, it's a very big non-compliance, directly go to authorities. So in certain situation, they are saying that you should directly go to authorities. That's a big change. And then they want you to document things. Document all the instances of non-compliant, non-nuclear, all the instances of nuclear, how management and TCWG and management responded to it, how you analyzed it, how you decided what should be done, everything should be documented. So all the instances of nuclear should be documented, how TCWG and management responded to it, what you did, how you considered, what are the points you thought about, how you analyzed it, how you decided what should be done, your thought process, everything should be documented. And how you ensure that public at large is not getting fooled, they are protected, you need to document that also. Now this documentation is as per nuclear. But then whenever auditor come across non-compliance, documentation is generally required. Asset 230. Asset 230 talks extensively whenever auditor comes across any significant matter. Significant matter means a big matter, something like significant risk, significant deficiency of internal control statement or material misstatement, or anything which affects the report, a very big non-compliance, a complete understanding of the significant matter, what are the different important points, conclusions, everything should be documented, specifically discussions. What discussions you had with the TCWG, with the management, with employees, with the experts, and what were the points discussed, and again, those details should be documented. So Asset 230 says that there should be proper documentation with respect to significant matters, and nuclear is a significant matter. Asset 250 says that you should have proper disclosure for non-compliances, and nuclear is a non-compliance. So when it comes to documentation, nuclear also says what needs to document. Standards on auditing also say what needs to be documented.